Rising loss costs, above average catastrophe activity, and emerging adverse trends in personal auto are just a few of the familiar challenges that U.S. property casualty insurers expected to deal with in 2022. Unfortunately, issues such as secondary weather perils, high inflation, and Hurricane Ian, second costliest catastrophe on record, demanded attention and resources as well. The end result of these factors drove the 2022 estimated combined ratio to its highest level in 5 years. We're here today with AM Best Managing Director John Andre, one of the authors of AM Best Annual Review Preview Report on the U.S. PC industry. And John, as we all know, the combined ratio speaks to the underwriting side of the business. What drove the increase in the combined ratio?
There's two drivers really that drove the number the most. And first is the personal auto. It's the industry's single largest line of business. It represents about a third of the entire industry and about 70% of the personal lines portfolio. So the results from that certainly moved the needle on the industry. And so auto physical damage has been impacted by the well-publicized supply chain issues and the impact of the 40-year high in inflation, level of inflation that you referenced earlier. The liability side is still affected by distracted driving, overall poor driving habits post-pandemic, rising loss cost severity driven by higher fatalities, and rising medical costs. Also, the restrictive auto approval process in many states for this highly regulated line did also contribute to the strain on the business. Additionally, when rates do get approved, that has been frequently been for less than the actually indicated rate request. As a reminder, we did move the market outlook for both the auto line and the personal line segment to negative in September 2022. The other major issue that should come as no surprise to observers but both insured and economic losses from weather-related and nat cat events continue to be above the long-term means as the frequency and intensity level of these events continues to worsen. ANA has estimated globally over 400 notable disasters in 2022 with insured losses of $132 billion worldwide, which is nearly 60% above the average of the 21st century. Of the global amount, nearly $100 billion was attributed to the U.S., including 18 weather or climate disasters of more than $1 billion each. The amount borne by U.S. insurers has led to a growing amount of actual and projected cat loads, with a slightly smaller percentage estimated in 22 and projected for 2023. But I'll remind people that's on a much larger premium base. About 10 years ago, the average from 2009 to 2013 was less, about 5.7 points. It's certainly a good indication of the increasing climate issue, a risk issue for the industry. Insurers continue to push for increases in most lines that have helped mitigate the weather impact, as well as improving other lines and classes of business that have been underperforming. One big offset to consider, though, is that reinsurance pricing, terms and conditions, and attachment points have tightened, especially for cat-prone lines and states and regions.
How did things look on the investment side of the ledger, especially when it came to unrealized losses?
Well, let's just touch on investment income first, because cash flows, frankly, have been sound. As you can see in the exhibit, the industry's estimated net investment income grew by a significant $16.9 billion to an estimated $73 billion flat, a considerable rebound from the prior year. However, that result was significantly impacted by a $10.8 billion intercompany distribution at one large reinsurer during the year, which flowed through net investment income in the third quarter financial statement. The PC industry would have still posted a noteworthy growth in net investment income in 22 without the impact of this transaction, although the growth would have been about 12% or so, and it would have paled in comparison with the 30% growth that you see in the exhibit. Despite the ongoing capital volatility, AM Best expects investment activity in 23 to remain relatively solid, generating returns much stronger than those of 20 and 21, but not at the level of 2022. Substantial unrealized losses estimated at $111 billion for 22, with a primary driver for the 9.4% decline in surplus at year-end 22. However, our analysis considers the strong capital position of most insurers, the positive cash flows, the additional sources of liquidity, sound risk management, and the ability to hold fixed income assets to maturity.
Now, the title of the report speaks to the industry's resiliency. Can you talk to us a little bit about that?
Sure. Yeah. First, let's just look broadly at the industry. And despite the issues of 23, 22, and what the rest of 23 is going to bring, the industry remains sound and in the aggregate well capitalized. Even with the surplus decline and increase in premium written, the writings to surplus is estimated to grow to just zero point 0.8 a year in 22 and projected for 0.9 in 23. Now, qualitatively, the PC industry is legendary for being responsive, for reacting to unforeseen events, taking lessons learned and using that knowledge to gain to mitigate potential damage for another similar event. Notable example for this is the pandemic, which aided in rapidly transforming the long-standing bricks and mortar industry to a more virtual environment. This sped up the implementation of insurtech-driven solutions related to claims, underwriting, and loss control. Another is the rise in frequency of wildfire that resulted in more robust, yet still developing wildfire modeling and enhanced risk mitigation. And a final of the many examples has been cyber, where threats and actual losses have led to the growth of a cyber subsection in the industry and formation of cyber specialists. So that said, you take all that into consideration, there will continue to be rising challenges, but we expect the industry to continue to respond to them and remain resilient.
Thanks, John.
Thank you, John.
That was AM Best Managing Director John Andre. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.